we're seeing in metals. And secondly, IT is facing the selling pressure today. So, on one hand, we spoke about the Mag 7 stocks and how they fell, but even the software stocks in the US were under pressure. So whether you look at an SAP or a Salesforce, they had a decline of 1.5–2%. Palantir, which is a very close proxy to perhaps what the Indian IT companies, but more of an AI play. But Palantir had a fall of about 7%. So yesterday, the Nasdaq fall was not limited to the large cap AI names, but even the software companies sold off. And I guess that rub off is visible today. So Infosys is now accelerating on the way down. That's down 2.5%. TCS is down 1.6%. HCL Tech 1.4% lower. And you go down the curve, you've got Wipro and Tech Mahindra also down nearly 1%. Yesterday, many of these consumer names were on the back foot. So the FMCG index was the lone sector which ended in the red. And this morning, you can see cuts continuing on HUL and an ITC. So IT is soft, metals is selling off. Asian Paints down for the second day in a row. So that's down close to about 1%. And this morning, even some of these large banks, which otherwise held up okay yesterday, HDFC Bank, Kotak Mahindra Bank, have opened in the red. On the way up, it's pharma. There is that US cancer shortage story. So pharma is generally upbeat today. Dr. Reddy is leading the gains. Cipla up half. Apollo Hospitals up and about. Adani Group stocks are seeing buying. So Adani Ports, Adani Enterprises, Shriram Finance deserves mention. Along with that, you've got a Bajaj Finserv up in the green. And the rally continues on Reliance. Yesterday was a big move, 2.5% gain. And this morning, consolidating with a positive bias.
Well, talking about those that have continued their form from yesterday's trading session, Kirloskar Oil, take a look at that stock. It was up 20% yesterday. It's up another 10% today. The JM Financial note clearly has excited the street, post the argument that valuations need to narrow between Kirloskar Oil as well as Cummins. So that stock now up close to 10%. Vedanta Group stocks, Vedanta Power, Vedanta Iron and Steel, and Vedanta Oil and Gas, all of them are in upper circuit as we speak. That's a 5% circuit, what we're looking at. On the flip side, Vedanta Limited, where that large trade has taken place, 1.7% equity changing hands. So that stock, in fact, is down close to around 5%. Since the dollar index has shown some strength, silver prices have shown some weakness. And that's why you have silver ETFs, Kotak Silver ETF, Tata Silver ETF, Nippon India Silver ETF. All of them are a little bit lower. New India Assurance has rallied 30%. No, not making a mistake, 30% in this month itself. That's coming for some mild profit taking in today's trading session itself. So net, well, we're trading with a bit of a negative bias. The good news is the mid-cap index is already moved into the green and the number of stocks advancing more than the number of stocks declining, Mangla.
Yep, and we do have a bunch of other names as well which are finding some favor. Sirma SGS, the joint venture with Kaga Electronics for EMS manufacturing in India, doing well for them. That stock's opened fairly in the green. We've seen a gain of almost 3.5%. The other one that stands out is Apar Industries. Has been doing well. Now, this deal with Saudi Aramco to supply base oils to them has been well appreciated by the street as well. And a word on Asian Paints, it's gone ex-dividend to the tune of 23 odd rupees. So if you adjust for that, the stock ticker is down about 14 rupees. So if you adjust for that 23 rupee ex-dividend, then it's actually a 9 rupee uptick that we are seeing on Asian Paints, and which is what was expected given the sort of decline that we've seen in crude prices already. Some of the consumer discretionary names are better off this morning. We have Trent, which is doing well. Commentary coming in from Sanjeev Bikhchandani on Info Edge also has that stock excited. It's among the top gainers today, up with a gain of almost 2%. Perfect time then to welcome our market master of the day, Nilesh Shah, founder of Envision Capital, joining in. Nilesh, remember the last time we spoke, you did like the digital platform plays and you liked the defense plays as well. Both of them finding a lot of favor, at least from the broking community right now. And the street is excited about the prospects here as well. Do you think you're nibbling into them as the markets are consolidating, or you're looking for newer ideas too?
So these continue to be the strong pillars of the kind of uptrend that we have seen on selective sectors. So while the large cap indices haven't kind of gained too much of ground, but very clearly there have been very strong sectoral trends, and clearly out there, digital platforms or digitization, defense and aerospace, driven by indigenization on the consumer discretionary side. There are plays both on premiumization and value. These are all very strong kind of domestic phenomena where the growth opportunity still remains very structural, very secular. And these are the kind of spaces or the sectors which I would continue to believe would remain in a strong uptrend for the near to short term.
Nilesh, hi, morning. Rima here. The big story overnight was this Meta-Cred deal. Meta investing $900 million into Cred, Kunal Shah being elevated as the global WhatsApp CEO. I know no direct implications for the Indian markets, but since this is such a big talking point, I wanted to get your thoughts in. And are there any indirect implications of how the space may evolve? And there could be some rub-off impact on stocks like Paytm.
Well, I clearly believe that the business models of these different fintechs are very different from each other. There is really no significant overlap. So to that extent, I don't think any kind of a negative rub-off effect on any of the fintechs or the payment tech companies. Just that this is one more global recognition of the power of Indian talent and the fact that a global name goes on to hire Indian talent to basically lead these businesses at very, very interesting times. I think it's a very big positive from a sentiment point of view, but I don't see any direct business impact for the sector or, for that matter, any of the other technology platform companies.
Hi, Nilesh. Good to see you, Ben. Nilesh, what are you making of the markets, though, as of now? There's one school of thought that it's time for us to catch up, and do well from here on, post the recent underperformance. Now the pieces are coming together. The rupee is stabilized. You have crude prices that have corrected, and hopefully that earnings trajectory continues, because now we have 3 whole quarters with hopefully not many, headwinds. And also you don't have an election for, I think, close to around 8 to 9 months from here on. So some reforms as well are looking forward to. Would you be constructive on the Indian markets? Do you think fresh all-time highs could be reached in the next 9 to around 12 months?
Very, very likely, Nigel. I clearly believe that the markets have consolidated quite a lot, both from a time-wise as well as a price-wise consolidation. The only missing link are essentially the participation from foreign investors, and 2 is essentially stronger earnings growth from the very large pockets of the Sensex or the Nifty, which is basically the IT sector and the banking sector. But on the whole, I do believe that there is a very strong case for earnings momentum on a very aggregate basis to be extremely strong over the next few quarters. Some of the policy initiatives that have been introduced over the last few quarters are going to play out in the times ahead. And if there is a further push in terms of policy reforms, that's something which would basically kind of give a boost to the market and also boost the confidence of foreign institutional investors as well. So I think on the whole, the outlook is constructive. I believe that probably the worst is behind us. And it looks like that over the next few quarters, we could kind of continue to see an uptrend, and hopefully the markets will make new highs.
Right. Sometime in the next 6 months, second half of this financial year, there'll be 2 major IPOs hitting the market. We will have obviously the NSE IPO, and given the filing on the DRHP, it looks like they will be within days of each other itself. Do you think that could cause a big liquidity event in the market? Because if you go by the size, it could be anywhere close to $8 to $9 billion.
Well, yes. I mean, surely that's going to basically absorb a fair bit of the liquidity as well. But I think as long as domestic liquidity continues to be strong, mutual funds continue to receive systematic investment plans, these would actually be looked upon as opportunities for domestic liquidity to deploy itself. So to that extent, I wouldn't be unduly worried about it. I probably think that these are 2 very differentiated offerings, which actually could trigger or catalyze the foreign investors to basically come in and invest into them, because these are both very, very unique opportunities. So to that extent, I probably think there isn't any kind of a material downside because of these 2 mega IPOs. If at all, it could actually trigger an upside in the Indian markets at some point of time.
One sector, Nilesh, you're most bullish on. If you had money to invest today, where would you invest right now? And one sector which is a complete avoid for you?
Clearly believe, I think digital platforms are the best structural and the most attractive investment opportunity. I believe that these are very strong consumer-centric businesses backed by technology, and many of them have created moats where they sustain market share. Yes, in the very short term, there is competitive intensity, but many of them have proven that they can deliver on unit economics, and they're pretty much raring to kind of scale and scale efficiently. So I clearly believe that this is clearly the strongest pocket within the Indian equity markets from a medium to long-term perspective. So that's one area that I would be very constructive on. I probably think the space that I would be a little cautious on is essentially metals. I clearly believe that many of the metals have run ahead of their times, and maybe it's time for them to kind of undergo some kind of price consolidation. So I think metals is one space which I think I would probably avoid at this stage.
What do you think of power, renewables, and the domestic manufacturing space? You know, it's been fancied as an important theme, but many on the street also believe that maybe just the valuations have run slightly ahead of the fundamentals. Would you be in that camp, or do you think that growth will take care of the current overheated valuations?
I think growth is always basically the best punisher. It's always the silver bullet. And any sector, any bunch of businesses which demonstrate superior growth are essentially going to get rewarded by the markets. Clearly believe that Indian manufacturing is evolving. It's coming of age. It's got tailwinds of several policy reforms. Surely there'll be many more policy reforms which will make Indian manufacturing more competitive. There's a lot of breadth. There's a lot of variety in Indian manufacturing, be it auto components, be it companies which are making components or equipments for the energy sector. There's defense, there's aerospace, and also the bilateral trade agreements which have already got executed and which are likely to get executed will also boost some of the conventional sectors like textiles or chemicals and pharmaceuticals as well. So I think on the whole, manufacturing is an extremely attractive space, and I still believe that Indian manufacturing will basically kind of show up quite significantly over the next few years and remains an extremely long-term investment opportunity.
Are there any names here that you like in specific? You can give us some direction.
So we own across all the sectors that I mentioned, be it defense, be it pharmaceuticals, be it auto components, auto ancillaries, or companies which are basically suppliers of components to power projects or renewable projects. I think we own a bunch of them. And we continue to maintain a more diversified approach, given that the breadth of opportunity is so huge that it's always going to be very risky just to kind of pick one player and bet on that, versus that it probably makes sense to have a diversified bunch of opportunities there.
Monsoon risk, is that priced in already to your mind, Nilesh? Or is that going to be a big headwind?
The fact that it's forecasted that monsoons are going to be below long-term average, I think that's something which is priced in. I don't think we've seen any significant rally in consumer staples or some of the other rural plays as yet. So to that extent, I think that's a bit priced in. The question is, the accuracy of the forecast. And I think as long as we have monsoons which are in line with the forecast, I think that's fine. I don't think the markets have any additional reason to worry about. But if the actual monsoons end up being far lower than what's being forecasted, then I think that could be a fresh source of worry in the short term.
Okay, got it. You were also bullish on the GLP-1 opportunity in the pharmaceutical basket. Has that played out, or do you think that's also still a structural opportunity? The entry point also matters.
I still believe that it's still early days for the GLP opportunity, and there's one way to play it, which is basically the direct play. I think that continues to be still very, very good, both the domestic opportunity as well as the global opportunity. So we like the GLP opportunity, and especially from companies which are direct proxies to those opportunities. In addition to that, along with demand for GLP medicines, I think along with that, there's a very strong demand emerging in the category of multivitamins, proteins, nutrition. These are pockets which essentially are ending up being collateral beneficiaries also of the GLP opportunity. And along with that, they remain strong proxies for aspirational lifestyle as well. So clearly, we are basically participating in the GLP opportunity through a combination of these subcategories, which is the direct GLP plays as well as the indirect GLP plays through the multivitamins and supplements and all of that.
Thank you very much for joining in, Nilesh. Always a pleasure chatting with you. Thank you.
Thank you so much.
Okay. In just moments from now, we'll get in the management of Aadhar Housing Finance. For the markets per se, it's back to that 24,100. That morning dip was slightly lower. We had opened about 30 points down, but that has been recovered. Things are absolutely flat, consolidating. Today is the Nifty weekly expiry. So generally, the second half of the trading session, the last hour, could be far more volatile.
If you're looking at the pharmaceutical space, there is another round of serious optimism out there. The morning we saw some outperformance, and now we're just seeing a build up to those gains. Look at Piramal Pharma, up 7.5% right now. Strides Pharma also at the high point of trade. We're seeing some traction in Laurus Labs. There's Syngene, which is moved to the high point of trade. We're seeing some buyers in Biocon as well, which too has moved to the high point of trade. And alongside that, on the frontline end, obviously, we have Sun Pharma and Dr. Reddy's, which have been outperforming from the word go in today's market so far. Divis and Cipla are among the top gainers on the Nifty as well. So the pharmaceutical pack looks like it's in a bit of a form, a purple patch of its own right now this morning with the kind of move that we've seen. Flat on the frontline index, the Nifty Bank also slightly flattening out. But the pharmaceutical index definitely on fire.
Well, I think another stock that's up, I think, is Space Digitech. They put out some ambitious guidance yesterday. There was a presentation that was uploaded. I'm guessing that is the reason why that stock as well is moving higher. It's moving higher on large volumes as well. So keep an eye on that one name. It's up close to around, I think, 8.5% or thereabouts. Just trying to see a 52-week high, because I think the stock had actually corrected from the top. Yes, it was at around 230 rupees, corrected all the way to around 190 rupees. Now the stock is excited because of the ambitious guidance that's been set out. So we'll have track delivery. Last 1 year, stock is still down close to around 10% after rallying 8% today. But the reason the stock is buzzing is because of their ambitious guidance that's out there. And Kirloskar Oil, well, it's not on a slippery wicket at all. Stock is up close to around 12% as we speak, following up yesterday's 20% run. So big move is what you've seen on that name as well. And as Mangalam pointed out, some of these other pharma-related names actually that have moved quite well. And as we did that check, the markets actually have moved into the green. So interesting times on that one. And yeah.
Curious, Nigel. We spoke about the QSR space with Dharmesh earlier. He said it could well be just a trading pop, no more than that. This morning we have Westlife Food, which has also seen a bit of a spike, up around 2.5%. Eternal is obviously the one that delivers. Swiggy is another platform, but when we say QSR, maybe Westlife Food is something that should come up for you on the screen right now. Jubilant FoodWorks was doing well in yesterday's trading session, up around 0.2% right now as well. But if you pull up the intraday chart of Westlife Food, you would see that maybe burgers on the house. Nigel?
Okay, before we get to burgers in the house, let's talk about the house itself, because we've got Aadhar Housing Finance now joining in. So they recently met ICICI Securities. There was a roadshow, and from that note, they believe competition is increasing in the affordable housing segment, but most lenders are focused on prime and mid-income housing, and Aadhar continues to dominate at the lower end, so the sub-15 lakh category. Rishi Anand, MD and CEO of Aadhar Housing Finance, is now joining in. Rishi, thank you very much for joining in. The broad narrative seems to be that affordable housing sales have fallen. Is that something that you've seen in the category that you operate in? How is the demand on the ground? Any numbers you can share for Q1?
Okay, great. Morning, Rima. As always, pleasure. You're right. There have been multiple reports which we also go through with regards to reduction in the supply side on affordable housing. The good part is when we talk about low-income housing, there is nothing to do with the construction activity. And I'll give you some statistics around it. For example, in my company, 35% of my consumers do something called self-construction. So obviously, the reports don't carry that data. Another 35% of the consumers buy secondary sales. Obviously, these reports don't carry that data. And the balance, 27%, 28% is low-risk property, low-ticket, low-risk property. Hence, overall, I don't think low-income housing, less than 15 lakh ticket size gets impacted by looking at one-sided reports on the supply side.
But what about monsoon? If water is not available for self-construction, for even the general, construction across segments, right? It doesn't matter. And what is not available? Has that impacted demand? Has there been a slowdown? And will that in some way affect the kind of collections or asset quality?
So Rima, when we talk about self-construction business, it is a seasonal. There is a seasonal impact, and it works both ways. Less of water also it slightly impacts, but if there are heavy rains, it impacts more. So it is more seasonality in nature. When there are moderate rains, that's when self-construction happens more. When there is heat, self-construction happens more because they need a little more time for things to dry up. So in terms of rains. Excessive rains will actually cause an impact on self-construction. So I would rather say moderate to better rains will be a positive impact.
So for now, do you hold on to that 22% AUM guidance that you've been talking about, 18 to 20% disbursement growth for this year?
Yes, Rima, we hold on to our guidance of 20-22% AUM growth, 17 to 18% disbursement growth, and 20 to 22% profit growth.
Okay. All right. Hi, Rishi. Good to see you, Ben. What about stress among your borrowers? Are there any signs creeping up? I think salaried customers, if I'm not mistaken, as a percentage of your mix is around 55%. But self-employed, self-employed is around 45%. So any signs of stress, or that's not really being witnessed?
See, these days, Nigel, when we talk about stress, there are two things that have been commonly talked about. One is the stress because of the West Asia issue. But the way I look at my business is the first point of difference is always the rise or drop in the bounce rates. Fortunately for us, last 8 quarters, the bounce rates have been very stable state, whether it is on the salaried consumers or the self-employed consumers. So are we seeing any impact as we speak today? No, we are not.
Got it. That's good. What about the cost of borrowing then? There have been various measures that have been announced by the RBI as well. There are some funding options that have come about as well. Could you tell us your take on it, and how do you see your cost of funding move from here on? The fear was that there could be a rate hike, which hopefully gets pushed back because inflation could be under control maybe till the end of this year. So your cost of borrowing, I think it was around 7.8%. You could correct me on that number. And how do you see it trending from here on?
So yes, you're right, Nigel. Our cost of borrowing as we exited the year was 7.7% to be precise. The first quarter numbers have been trending well. We are again at about 7.72. So I would not say there is any change in the cost of borrowing. Resultant of which our spreads are a steady state at about 5.5, 5.6%. Yes, you're right. I think the industry was expecting that there will be a raise in the interest rate, which fortunately did not happen. Our belief, the way we look at the current situation is in the current financial year, we are expecting a 25 bips rise in the rate. Fortunately for us, the way it works, Nigel, is 75% of my borrowing and 75% of my asset side, both are floating in nature. So whatever comes in eventually moves on either ways to the consumer. If there is a drop, it gets passed to the consumer as we did in February this year. 15 bips was passed to the consumer, and if it rises, to whatever extent it is passed to the consumer.
Okay, and your NIMs should be maintained, I think, in the vicinity of what it was in the past, 8.5%, if I'm not mistaken?
The NIMs?
Yeah.
The NIMs, we closed the year at about 9.18. I think that is a comfort zone that we'll be at even in the current financial year. Okay,
around 9.2% is what we could work with, right?
That's right.
All right. LAP as a percentage of your portfolio, I think that's holding at around 25-27%. How do you see that panning out from here on?
Nigel, if I look at the way the regulator tells us and the way, since we are a regulated entity, 60% of our balance sheet has to be individual home loan retail, which effectively means broad-based, effectively means 70-30. Today I am, and you're right, my numbers are about 27% low ticket loan against property. I think that's the good space that we would want to be. We would not want to be closer to the breach point. So 27-28% is what we're looking at in the current financial year.
Okay. And a final question then from my end before I let you go, Rishi. Return ratios, that's ultimately what gives the valuation. You're talking about good growth from here on, but what are the targeted ratios, ROE, ROA?
Nigel, I'll talk about not only the current year, I'll talk about midterm. The way we look at last year exit was 4.4 ROA and about 15.9 ROE. I think we have into FY24, if my numbers are right, we delivered a 4.2 and an 18.4. I think that is the sweet spot we will be looking at in the short to medium term, a 4.2 and an 18% kind of ROE and an ROF of 4.2.
Okay. And in your long-term target of getting to 50,000 crore AUM by FY29, is there going to be a change in the geographical mix?
Rima, see, we are a company which is spread across all the states, possible states in the country. We are at 22 states. There's about 626 branches and growing about 50 branches more. I would say from a pure risk perspective, when it comes to top three matrices, which is AUM, disbursement, and distribution, we will be evenly spread. We don't want any state to cross 15% contribution on all the three parameters. So the current geo mix is going to be stable state, even from a slightly, I would say, longish term perspective.
And what percentage of your, the disbursements that you do is digitally sourced? Now, everyone seems to be talking about how AI is doing the job and assessing credit and the kind of loans that you're giving out. For y'all, is there a number?
I will try and give it a slight twist, and purely because of the segment I deal with, Rima, I will not expect my consumer to go on a digital platform and apply for loans. These are low-income consumers. They are the bottom of the pyramid, but another perspective is that today 100% of my consumers that come on a digital platform. So I don't create physical files. Everything is on a technology platform. As we talk about technology internally, I think we are an organization, we would be one of where even we are ready to do a sanction in 30 minutes. So we are as ready as a 30-minute sanction. But, the consumers will take a little more time to respond. And as a data point, today, 6 to 7% of consumers don't even have a smartphone. They work on keypad phones. That is the consumer you're dealing with. And hence, it is very important for people like us to reach out to the consumers. Hence, I would say the large branch network is required. But having said that, I am very, very positive when it comes to my consumers. I would say outer side, a couple of years down the line, they will be, and we can see early signs of consumers becoming tech savvy. I have a consumer app where consumers are coming in and applying for their requirements. But from a pure digital sourcing perspective, it's slightly away. But we do multiple things on digital platform with respect to sourcing, with regards to leads coming from various digital sources. All that happens, but consumer directly coming, I think it will take a little more time.
Okay, thank you, Rishi. Always great chatting with you. Thank you for joining in. We will get into a break. On the other side, the management of Elgi Equipments will be chatting with us. Stay tuned.
Welcome back. Well, the markets have moved into the green. The Nifty was down 40, 50 points just to start off trade with. And guess what? After a while, we're outperforming because the Kospi is down more than 4%. I think the Japanese index as well was in the red. So India has moved, into the green, which is good news. Hopefully, our time has come in terms of an outperformance. Well, let's focus on the next management. Elgi Equipments, that's the next management on our radar. Remember, the stock is up close to around 30% or thereabouts. To help us out with how business is shaping up, what's the longer-term goal, we're joined by Mr. Jairam Varadaraj, the Managing Director at Elgi Equipments, who joins us. Hi, sir. Good morning. Thanks a lot for speaking to us here on CNBC TV 18. Well, you've made a few announcements, so let's get straight to that. You have elevated a senior leader like Mr. Seng, specifically to head Americas as well as Europe. And, I was looking at the last few quarters, you have now broken even in both the United States as well as Europe after, a few difficult quarters as well. So could you tell us what is the revenue and the margin ramp up in both these two markets going ahead?
So thank you. It's great to be in your program. For us, Europe and the US are very strategic markets besides India. And Indranil, who has been a CFO for almost 3 years now, has got a good sense of the business. And we need someone to lead it, bring the home office flavor into the respective subsidiaries and bring the subsidiaries into the home office and create a greater integration between the operating units. And that's really the intent behind it. In terms of growth, we are looking at mid double-digit growth in both these markets. We have broken even in Europe, and we are profitable already in the US. So this growth trajectory is going to give us quite a bit of a positive EBITDA in the future.
Okay, so you're saying that double-digit growth in both these two markets with improving margins, since you're broken even in Europe, is the trajectory going ahead?
Absolutely.
Right. What's the timeline that you'll be taking to appoint the new CFO?
So the process is typically in a senior leadership position like this, it will take us anywhere between 6 to 7 months for someone to, get into the role and settle into the role and be able to take on. So that's the kind of timeline we are looking at.
So 6 to 7 months is when we should hear on the new CFO as well of the company. I was looking at the strategic plan that you've laid out for analysts as well. You're looking at nearly 7,500 crores in terms of revenue, $750 million USD. That is about an 11% CAGR over the next 5 years. I look at your last 5 years, you've obviously grown at mid-teens. So I'm just trying to understand whether it's base effect or are you under-promising and looking to over-deliver here?
So our tradition has always been to over-deliver, keep the promises light. But, in the last 4 or 5 years, we have seen a lot of uncertainty in the environment. COVID happened, then there were metal commodity fluctuations, then the tariff happened, now the West Asia problem, Ukraine war. So there is quite a bit of uncertainty in the environment. So we have to moderate for that. And that's the only reason why we are being conservative in looking into the future. The business fundamentals are solid. We have got very deep stake and presence in all these critical markets. We have repeat customers, and which is an indication of very good acceptance of the product. All this is solid, but the environment is something that we are unable to predict.
You're also targeting after-sales services to contribute about 20 to 25% of your overall top line. What is the current contribution and what is the margin profile of after-sales?
So the current contribution of aftermarket will be on an average across the world would be around 16 to 18%. And that's the current prevailing level. In terms of profitability, the aftermarket is about 2 to 3 times more profitable than equipment sales. And that's really where in a business like ours, this is really where the profit driver is aftermarket.
How soon do you get from 16-18% to 25%?
Yes, that's the goal. Yes.
Now, how soon? Will that happen in 3 years, 5 years, FY31?
I think we have given a commitment for the next 5 years that we will move our EBITDA from the current levels to around 18%. As part of moving that to that 18%, a big part of the contribution is going to come from aftermarket. So I don't think it'll move to 25% in that 5-year period, but certainly in the 20-22% level is where we are expecting it to land.
Got it. All right. Since you're focusing on the India business, I think you're expecting India to outpace the growth of the company on the whole. Would that be a fair estimate?
Well, India growth is definitely higher than the rest of the world growth, and therefore our growth in the market is going to be higher. And we also have India as a very strategic market, and we have created multiple plays in the Indian market. One is our go-to-market for existing products. We are launching a new range of products for a different tier in the segment. So all these are going to be very strong contributors to our growth in India.
I think India from around 45%, you're expecting it to contribute around 53% as you go through to that goal in the next 5 years or so. Is that correct?
It really depends on, how the rest of the world. Today it is roughly 50-50. India is 50 and the rest of the world is 50. In terms of the future contribution, we are working in Europe and the US, which are very, very large markets. And if we are able to gain very solid traction in these markets, then the contribution definitely will be far higher. So that's not a goal that we are pursuing.
Are you seeing signs, though, that the capex cycle is turning here in India and things are picking up?
Absolutely. I mean, I think there is a positive sentiment, but there is a pause to really find out where the world is going to settle with West Asia. Now, once that is settled, I think it's the speed will pick up. Right now, the inquiries are strong, but finalizations are taking a little time. Yeah.
Just wanted to understand a little on your sales mix as well, because air compressors still over 90% of your sales, and you have automotive equipment, which is a margin dilutive business that's a lot lower. Are you going to see a notable shift in the contribution that comes in from the automotive business, and will there be signs of improvement in the margins here as well?
To answer your first question, I don't see a shift in the percentage contribution of the automotive business to the overall portfolio. In fact, it could start shrinking because we expect the compressor business to grow a lot faster. And definitely, we are working on multiple initiatives to improve the margins there. So that could also be contributing to overall consolidated performance.
And is one of those initiatives also to reduce your import dependence? Because I remember it coming down to about, or your own manufacturing to be about 88%, and you're targeting this to be almost 95% plus. How much of an investment will that take, and how would that move your margins?
I don't think it's too much of investment, really. It's a indigenization of many of the products that we are buying from different parts of the world. This is something that we have taken as a part of the initiative to improve the margin, because the volatility in the exchange rate is something that caught us a little blindsided. So we are taking that as a serious situation for the future, that the rupee will continue to be weak, and therefore we are looking at insourcing a lot of the products into India.
All right. Thanks a lot for joining in, sir, and wish you good luck for the long-term guidance that you've given. And for us here, everyone will be very happy if the India capex cycle picks up and gets some steam, because then that starts to roll the GDP engine as well. And once that happens, people start earning a lot more and then spending a lot more on discretionary consumption. And that's exactly what our next discussion is all about. Cordelia Cruises' parent, Waterways Leisure. Thanks a lot, sir. Okay, let's move on. Let's talk about the IPO corner now. We have Waterways Leisure Tourism's near 600 crore rupee IPO that opens today for subscription. Obviously, this is known better as the company that operates Cordelia Cruises, and it's the price band is up for you on the screen, 769 to 808 rupees. And they're looking at a post-listing valuation of closer to 5850 crore rupees as well. We do have Ergen Bayong, who is the chairman and CEO of the company, who joins us. Along with him is Nishikant Upadhyay, who is the CFO as well. Thanks a lot, gentlemen, for joining in, and good luck. Welcome to the stock markets as well. Welcome on board, as they say, on some of your cruises as well. When I look at the offer that you've made, it looks like more than what you're doing currently. A lot of the growth hinges on what happens over the next couple of years, because currently you operate one cruise, which is the MV Empress, and over the next 2 years you do have the others coming in as well, Norwegian Sky and Norwegian Sun. I just wanted to understand what's the kind of economics that you factored in with these two, because from a one cruise operator you're suddenly becoming a 3 cruise operator. Does that mean your revenues and earnings increase proportionately as well? Do we see them tripling or even quadrupling from here on in the next 2 to 3 years?
Well, first of all, thanks very much for having us, and very good, valid question. So, yes, we are operating currently one ship in operation, but do remember, please, that the other 2 ships are already with us since last year, since 2025, and cruises are sold 18 months in advance. So we're already generating revenue, and these ships are available. So you see the one ship we have currently, which you know how much money we generate. The newer ships which we are getting, they are far more premium. They have 1000% more quality cabins in terms of balconies and suites. They're 200 rooms per ship bigger. So yes, so if you do the calculation, each ship, so we're talking 250% more capacity, then better cabins, then I think you can do the maths.
I just did the math actually.
Yes.
You know, your average revenue per passenger is close to around 110,000. 120,000 in the last year. If I use just that metric and your current occupancies for the next year with a 20% bump up, it looks like each of these new ships could give you anywhere between 800 to 850 crores in annual revenue. Would that math be off, or am I under calculating? We have the CFO with us. Please tell me.
Under calculating.
So I think you are calculating basis the Empress which is there.
Yes.
So he rightly pointed out that Empress has 796 rooms, whereas the Sky has 1,000 plus rooms. Empress has 69 premium cabins. However, the new vessel Sky has around 260 premium cabins. It is just like in the airlines where the premium economy and economy, that's the concept. And the demand for the premium cabins is across has been very large since
It's actually higher than regular rooms.
And globally also, Indian are known for taking the most expensive cabin. It's a known fact, which is a fact. So the numbers, certainly there are restrictions, we cannot speak, but yeah, the
We can
performance
calculate. So 800, 850 becomes 1,000.
So
right?
we in our business, we talk passenger cruise days, right? So each room has 2 people. All rooms occupied is 100%. But remember, we are not selling rooms, we are selling beds. So we have actually 400 or 500 beds more than rooms, so we can have 120% load factor.
You know, gentlemen, Mangalam is pushing all for that 800 to 1,000 crores odd. But you all are saying that the ships that are coming on are bigger in capacity and they're better as well. So from around 600 crores that you all did last year, in terms of revenues, effectively 250% is what you said. So the potential, say, in the next 3 years or so could be 1,500 crores of revenue. Would that be a capacity, that you could actually scale to, and that could be an aspiration?
So see, 796 rooms goes to 2,800 rooms, and this almost
4x.
8, and the premium cabin mix is increasing by 1,000%.
So effectively, your revenue potential goes to 2,000 crores plus then.
3,000.
Arithmetics can be what you are mentioning.
3,000 crores.
Okay, and what happens with the profitability? I'm just trying to understand a couple of more things from you. While you have, spoken at large about the quality of these ships and all of that and stuff, they're also 23 to 25 years old, right? Typically, what is the residual economic life of each of these ships, and what's the annual maintenance that you have to pay for something? And while all these things, from a revenue generation standpoint, sound very good, we need to understand the break-even points here as well, because fixed costs are large in a business like yours.
Good
and
question.
occupancies, and there will be annual maintenance as well.
Very simple explanation. So cruise ships don't have such things live like a cargo ship.
Okay.
Because we have 800 audits a year. We are heavily regulated, about 30 times more regulated than the airline industry. We have a program that's called preventive maintenance. So we have to maintain our vessels every single day. And we are spending a good amount of money doing so. By regulations, each ship has to go out of water every 2.5 years or 2 times within 5 years. In our case, it takes about 7 to 8 days. We are going quickly to Dubai, coming back. And even that, we are going with passengers and coming back. And then, so there is no such life because the ships are continuously upgraded to the latest standard. So basically, the steel is 25 years old. In the inside of the ship, everything is brand new.
So the break-even point.
Break-even point is very simple. 60% load factor in the lowest pricing, we break even. And we are under dynamic pricing, so we have 3 slab pricing, 0 to 30% load factor, 30 to 60, etc., 90 to 120% load factor. 60% is the lowest ticket fare, we break even.
And you said the maintenance cost is quite high. So over a period of 5 years, when you do those 2 rounds to Dubai, how much would you be spending?
Actually, we spend approximately $250,000 to $300,000 a month. So it's about $3.5–4 million a year. But if we divide it again by passenger cruise days, it's not that much.
Okay. All right. So revenue potential, we have gone out of the way. I'm just looking at the last few years. The margins have come down. From I think upward of 30%, it's come to around 20%.
No, I
So
think...
you can explain that to me, point number one. Point number two is the cash flows are negative. So explain that as well, sir. Please go ahead.
So first of all, in terms of margin, if we have adopted Indes,
so
right? And by virtue of Indes, since vessel Empress is owned by us right now. So there is no point in discounting the lease rentals. My lease rental has two elements. We have been consistently paying $28,500 per day lease rental to the third party earlier or to the company which was providing the vessel. Out of this $28,500 per day, which works out to around 900K in a month. $1 lakh is only the lease rental. Rest is reimbursement of expenses. So when we decided to go for an IPO, then we saw that there is no point in creating right of use of assets and liabilities on future expenses which we will be incurring. So then we agreed, but since in the middle year it was not advised, so that was changed on April 2025. So now my leasing is 1 lakh and rest is reimbursement of expenses. So when we compare 2025 with 2026, there is an 87 crore worth of expenses which was coming as a below the line item in the EBITDA. Now it is getting captured in my above the line, and the specific line items are the crew wages, the insurance, the maintenance, and the management fees. So the line items are legal and professional, the crew wages. These are the 87 crores. If it goes up, my EBITDA is better. Though the turnover for the 2 years, 25 and 26, we compare, is lesser by 10 crores, but my EBITDA is better if I nullify this.
Here on, what should we look at as an EBITDA margin?
35 to 40%.
35 to 40% reported basis.
Yes,
so this 19% turns to 35 to 40%.
Yeah.
On a revenue base which is going to triple or a little more from here on as well.
And now in terms of number also, when you are talking about the cash flow negative, if I compare the financial year 2025 and 26, for the sake of a better understanding from the investor perspective, my suggestion is don't go by EBITDA numbers, go by the profit before taxes and exceptional line items. Last year it was 113 odd crores. This year it is 79 odd crores. Whereas the 79 odd crores absorbs around 40 odd crores additional expenses which we have incurred, because since these vessels, as Jürgen rightly pointed out, that we have started booking the vessels, so we have increased the manpower, we have increased the office space. So that is around 40 odd crores which has been getting absorbed in 2026 numbers. Going forward, maybe probably I will not be able to speak, but then this expansion would not be there. So in terms of expense.
Any revenue which is unrecognized from these new ships because you forward book it? So 18 months of revenue. Could you give us a sense on what that number is?
So if you talk about Empress, I normally sit on a advance cash of 125 to 130 odd crores, which will answer his question as well. When you talk about negative cash flow, in my 26 numbers, there is a negative operating cash flow of 96 odd crores. But this is not negative. Rather, it is reverse. If you see, there is a line item where there is an advance which is being shown, which is 162 odd crores. What is this advance? When I acquired vessel Empress, when I acquired vessel Sky, on the day in the month of April 2025, when I was about to sign the agreement, I was required to pay $16 million advance, which is almost extended 160 odd crores. So this is an advance for the vessel. Since it is an asset lien structure, it is a transaction wherein advance lease rental has been paid. So it is getting, if you nullify that, then I'm sitting on a reverse side on a positive cash flow of around 80 odd crores.
Are there any risks to your business from what you see right now? Because everything that you're speaking about looks like it's a blue sea scenario, not a blue sky scenario, right? Is there anything that potential investors should be worried about as threats?
We have the same risks like everybody else has, geopolitical situations. We have the same health risk when it comes, like, if you want to refer to COVID whatsoever. I mean, we were the first people who start during COVID. We were the first tourism sector starting during COVID. But we general, what is our advantage? We have movable assets we can shift, right? Like now, when the rain starts, we're shifting to the other coast. We have sunshine 7 days, 24 hours, plus we operate 365 days a year. We are not seasonal.
Okay. All right, gentlemen. Thanks for joining in. When we were looking at the post-listing market cap, it appeared that you're coming at a price, market cap to sales of around 10 times or. But as you're telling us, capacity is coming on stream, so it appears now it's around 2 times or thereabouts. So we're letting you all go at this. All the best for the IPO. On listing, we re-invite you all, and that time we'll push you all a little bit more for some numbers. Thanks a lot for joining.
Thank you.
Thank you.
Well, let's welcome our technical expert then. We have Chandan Tapare who joins us. Chandan, what are you making of today's initial trading action? And also fill us in with a couple of epics.
Yeah, good morning. Thanks for having me. So the market is positive to range bound as a small decline is being bought, but trend is positive. So positional basis, we have support near 23,888. Till that holds, index has potential to head towards 24,224 to 24,444. So buy on decline and positive to range bound bias in the Nifty. Looking at the Bank Nifty, it has been consolidating from last 3 days, but supports are intact. With support of 57,500, use any small dip for the next leg of rally towards 58,500 marks. Looking at the stock specific action, positive on the Nifty Pharma, and most of the pharma counter looks good. Whether we talk about the Biocon, Lorest, Lupin, Cipla, Glenmark. But here I would suggest to go long on Biocon, which has given a consolidation breakout. Major trend is positive. On the weekly chart, it is all set to give a breakout from pole and play. So buy with support of 423 for target of 455. Second trading area, that is buy on Oberoi Realty. After a long time, the real estate sector is bottoming out. Consolidation breakout with build-up of long position is clearly visible. It has given a decisive close or hold above 1700, 1720. So buy with support of 1697 for next leg of rally towards 1800. Last but not least, that is buy on Bharat Forge. Strong momentum has been making higher top, higher bottom. Buy with support of 2085 for target towards 2210.
Chandan, thank you very much for that. Oberoi Realty, Biocon on his radar. In fact, the entire pharma basket is up. Cohance 10%, Piramal Pharma 10%, Aarti Pharma 7%, Newland Laboratories 6%, MCure 5%, InSwift 5%, Jubilant Pharmova, Alembic, Natco, Loris, Panacea Bio. Across the board, you're seeing some big moves. Get into a break. On the other side, we'll come back and talk commodities with Manisha. Stay tuned.
ये हैं कोटक नियो के तेज ट्रेडर।
निकी इंडेक्स डिप्स एंड स्नैप्स बैक।
ये ट्रिगर गिरावट का है।
कसम कैंडलस्टिक्स की। बेचो और बचो।
ये करते हैं शोर को इग्नोर और ये हौसला जानकारी और तैयारी से मिलता है। स्टे तेज विद कोटक नियो। इन्वेस्टमेंट्स इन सिक्योरिटीज मार्केट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल रिलेटेड डॉक्यूमेंट्स केयरफुली बिफोर इन्वेस्टिंग।
Welcome back. Let's turn our attention to commodities. Manisha is now joining in, and crude prices continue to trend lower, $77.5 per barrel. Manisha, over to you.
Well, thank you for that. Yes, overnight markets have seen 3% of a decline for the crude oil prices. But interestingly, the volatile moves in the crude prices just about continues. If you look at the trading range that we saw in crude yesterday, the high was 81.5 and the low was almost at 76.5. And that's exactly where we seem to be trading at this point in time. It's a 19% of a decline that we have seen in case of crude oil prices in the matter of last 1 month itself. Well, US issuing Iran a 60-day license to sell oil in international markets has eased the risk premium slightly there. And then the shipping activity via Strait of Hormuz seems to be increasing as well. If you look at the overall number, well, the reopening of the strait has unlocked an estimated 100 million barrels of oil that has been awaiting transit there. Also, when Iran has shipped nearly 30 million barrels of crude in the last 1 week itself, and as per the Kepler data, 35 ships went past the Strait of Hormuz on Saturday, 17 on Sunday. It was a single lower digit on Monday as well, but that number is expected to increase. And then you also have countries and major producers like Kuwait and UAE looking to set alternate routes for crude exports. Well, the only reason that you didn't see the crude prices 140 even as the Strait of Hormuz was shut is because there was crude already on water, and then the alternate routes were actually put to higher capacity as well. Interestingly, there also is an IEA sentiment or data that says that the war has blocked 14 million barrels per day of West Asian oil output, which will start now coming into the markets. The IEA also says that the supply will surge by nearly 8 million barrels per day in 2027, while the demand is estimated to go up only by 2 million barrels per day. So we're looking at an excess supply, a surplus, and that perhaps is the reason that you're looking at lower price forecast for 2027. The only one thing that seems to be supporting prices somewhat is the U.S. crude stocks. When you look at the SPR, well, that is down 331.2 million barrels last week to a 1983 low. And the U.S. crude inventories also have continued to decline. The last 3 weeks have seen very strong declines come into the market. And with that, it's nearly an 8-month low that we are looking at in sense of the U.S. inventories as well. The final chart should come in on your screens, and that tells you on what the latest updates have been in sense of crude price forecast going forward. And those updates clearly have been coming fast enough. Wood Mackenzie is talking about $92 a barrel in this year, but they have a much lower forecast of $79 a barrel in 2027. EI has already spoken about 105 and 79 again on the lower side in next year. ICICI Banks has talked about 79 this year itself, and they're talking about a range of 65 to 75 for the next year. JP Morgan 60 this year to 57 next year. Markets, there have been some reports suggesting that if the supply glut continues to come in very, very strong, you could be looking at mid-50s of a price as well. And then Saxo Bank believes that the near term is going to be choppy, but next year they also believe that it is going to be a lower average in sense of crude prices. 75 is a number that they have put out for that one as well. And then Goldman Sachs has talked about 85 this year, 75 next year. Morgan Stanley hasn't given a 2027 forecast yet, but $80 a barrel, so lower than Goldman Sachs. Citi bearish again, 70 this year, 65 next year. Barclays 100 this year, 80 next year. And then you have Crystal Energy believing that $60 of an average price in the next year is a possibility. And when you talk about a 60 of an average, that means you're looking at sub-60 kind of levels continuing in 2027. So bearish cues coming in for crude from here.
And that's reflecting in our markets because the Nifty, after a slightly muted open, has picked up now. It's 24,124 on the Nifty, up 21 points. Get into a break. On the other side, Lata speaks to former SBI Chairman Dinesh Khara and former Deputy Governor of RBI, S.S. Mundra. In our special segment, It's the Economy.
Welcome to It's the Economy. Last week, Betra, an institute that trains bankers and banking aspirants, published some eye-popping data. It showed that profit growth and fall in NPAs of public sector banks has been better than private sector banks in the last 5 years. This has been, of course, acknowledged by the market with PSU valuations rising. But one statistic from Betra is probably not known to all of us. Despite accounting for 61% of total banking business, the total number of PSU bank employees are less than the total number of private sector bank employees. I mean, just imagine, total employee strength of PSU banks has been stagnant for 5 years, while that of private banks has risen by 32% in 5 years. What explains this huge fall in hiring? Does this need to get corrected quickly, or will it at least lead to loss of more market share? To answer all this, I have with me two veterans from the public sector banking space, as it were. Mr. S.S. Mundra, he's former Bank of Baroda chairman and former Deputy Governor of the Reserve Bank of India, and Mr. Dinesh Khara, former chairman, State Bank of India. Well, incidentally, State Bank of India has not lost as many employees as the rest of the public sector banks, but it is still not keeping pace with the rise in employees that we have seen in private sector banks. So, Mr. Khara, actually that question for you first. How do you explain this? I mean, even State Bank has seen a fall in employees FY22, 23, 24. And then there is a minor increase, which is better than other public sector banks. Why that?
Well, Lata, thank you very much for having me on your show, first of all. Well, the subject which you have touched upon is essentially relating to, when it comes to percentage growth or percentage decrease, it has to be seen in the context of the baseline. So when it comes to private sector banks, of course, they have seen a significant growth, but they have also got the baseline, impact also is there. Similarly, when it comes to legacy banks like public sector banks, they also have the impact of the baseline. So I think that is one area which we need to really keep in mind. The other aspect is that over the period of time, when it comes to public sector banks, they have also centralized their processes quite a lot. Other aspect is that when it comes to the cost of employees, maybe up to the level of AGM, which is actually the senior management grade. So there, the cost of employee for the public sector bank is much higher as compared to the private sector bank. And also when these banks are now oriented in terms of meeting the market expectations, they have to ensure that their cost to income ratio remains within check and control. So that is the other aspect which has to be kept in mind. Having said that, we have to keep in mind the service on the counter. So that is the reason why perhaps the kind of model which has been followed by private sector banks in terms of having the back office processing centers, or maybe the subsidiaries which are doing the feet on street kind of a role. This was adopted by public sector banks also in the last about 5 years plus. So I think that is the other aspect which actually helps them in terms of containing their cost, and also at the same time meeting the expectation of the customer on the.
Yeah. So actually, when I was doing my homework for this discusussion, I did speak to a lot of current public sector bankers, and they gave some of the similar reasons that, mergers took some rationalization. The cost of their, tier 1 lowest level employees is higher. And so they have these subsidiaries, Union Bank, BOB, all of them have subsidiaries where all the sales people are employed, where you can give variable pay, where the starting pay is lower, it is not as high. They've gave those reasons. But those subsidiaries have a few thousand. Like all told, with all banks, it'll be 5,000-10,000. But I just want to pull up the numbers of employee strength. Look at the private banks and the PSU bank. Can we get that table? Private banks were at 6 lakhs in FY22. It has gone up to 7 lakhs, then 8 lakhs in 2 years. Whereas the employee strength of private public sector banks is almost stagnant. It's risen a bit only in the last year. Mr. Mundra, what is your sense, sir?
Yes.
What is stalling? And will this not impact? See, ultimately, they are serving 60% of the sector, but they have fewer employees. This beats logic.
Okay. First of all, thanks, Lata, for having me here. And yes, I mean to say, fact cannot be taken away. If you the data which you have mentioned, the head count in public sector banks from 22 to 26 has rather reduced marginally by 4,000. It was 7.94 lakhs in 22, which has come down to 7.90 in 26. And private sector banks, as you mentioned, has increased from 6.31 to 8.30. There are 2-3 factors let us keep in mind. First, as Mr. Khara also indicated, number one, these data need little more granular details and deep delving, because we don't know how much are outsourced, how much are contract worker, what are sitting in subsidiaries and all that.
Yes.
But having said that, I fully agree, fact cannot be taken away.
Only 2 lakhs is my point.
Yeah, it can't be so much. But we should also understand that this period which we are referring to had been a period of consolidation in public sector banks. And large banks were created, and the whole purpose was to rationalize the headcount as well as the branch network and reduce the duplication and redundancies. I think 22 to 24, that happened. Again, you will find very interesting, from 22 to 24, the public sector banks had a negative growth in headcount as well as in branch network. Private sector banks had a double-digit increase in headcount. Then 25 public sector banks came in positive territory. Private sector banks went into negative territory.
Yes.
And in 26, the increase in headcount and public sector banks has surpassed what it is in private sector banks.
Okay.
So what I mean to say, there is a period of transition, but I fully agree there is a need to have a relook at it, because the per employee business in public sector bank is much higher. Yeah. But again, if you compare it with the profitability, 22 to 26, public sector banks have shown good performance. There has been almost a 3-fold jump in profitability. But again, because there was a period of NPA, there was a period of write-off and all that. But what is important, during this period, the profitability of private sector banks put together had almost reached to the level of public sector banks, despite having less than half branch network, less than half per employee business.
Yeah.
So the point which is coming out, large branch network is not necessarily bringing the business or profitability. I think private sector banks have been able to deploy the people in large number at the centers, which bring greater profitability. And that is why I said some deeper delving is required. If you look into the non-interest income, fee income, CASA ratio, I think these are the areas where the headcount is put and it is bringing revenue as well as profitability. So it's a mixed bag. It's a period of transition. It needs little more analysis. Recent trends are different, but fact remains, yes, it needs to have a relook.
No,
but
every sentence you say...
Just 30 seconds. But there is a twist to that because of the last 1 year development in the global economy that I'll come to later on.
Okay. Actually, this requires a half-hour discussion. I'm sorry. Mr. Khara, do you think I looked up, the kind of jobs that public sector banks are forced to do. Do you know, I mean, I guess you know this at like the back of your hand. The total number of Jan Dhan accounts, 96% is with public sector banks. 96. I mean, that would be labor intensive. In spite of it, their total number of workers is less. So, I mean, I just want to ask you, is there a policy problem? Recruitment has to be by national exams and stuff like that. You can't do a lateral hire if you want someone for AI. You have to still wait for the entrance exam, is it? I mean, are all these the problems that will choke the growth in future?
Well, I think that's not as much of a challenge. There is, of course, recruitment has to be done through an exam, which has to be a national exam. And there also we get to see different trends. People are coming from certain geographies. People are not coming from certain geographies. But public sector banks have got a responsibility in ensuring the branch network across the country. So I think they do face some kind of challenges in terms of, today's generation perhaps is not as keen for the mobility within the country as much as perhaps in the good olden days, people were around. So that is one of the challenges that right.
Compulsory transfers.
Yeah, compulsory transfers. And moreover, transfer will depend upon the positions where they are available. And so that also involves, people to pick up the language, local language, etc., etc. So those are the realities which cannot be denied. But yes, having said that, I must also mention that there is no such restriction when it comes to hiring people with the skills which are relevant to the banking system. And I think on that particular matter, various bank boards have taken very pragmatic steps, and they have actually hired people from the market wherever there was a skill deficiency within the system. That is one of the reasons why we have seen the kind of digitization in the public sector banks over a period of time. And I think when it comes to the newer trends in terms of adoption of AI, etc., the models which are required to be developed within the banks have got, if at all they don't have the requisite skills, they can always hire it. Maybe it could be on contract. But yes, of course, we have to keep in mind the kind of aspiration and expectation of the people who want to take up such kind of roles.
That's a fair point.
People actually want to come into the public sector banks because of the scale, because of the variety which they offer. So I think in terms of their professional maturity, it certainly contributes in experience in the
Fair point. Mr. Mundra, we have just a minute left. I mean, is this a recipe for decline? And what's the answer?
Yes. So as I was mentioning, and maybe perhaps we can discuss more after details, as I said, last 1 year development, we all have been hearing something like Zen AI and Agentic AI. So having a lean strength and maybe focused on technology, which has been in recent year, I think it is an open question whether it will be a blessing or it will continue to be a problem. So we can continue to discuss on this maybe after your break.
Yes, sir. So we will have to meet again and have a longer discussion on this. I take your point. This is a very important point that needs further analysis, because public sector banks still have a large reach, social role, especially in terms of inclusion. I'll invite both of you yet again for a bigger discussion. Thank you very much for joining me. Yes, one hopes AI will be the answer, and that's what markets are prepared for. But somehow I feel private sector banks will not be so foolish as to overhire. There may be some business that they are taking away from public sector banks, and so the government better watch. On that note, we wind up on this discussion after a break. Chartbusters.